Hello, and welcome to a discussion of Chapter 4, Investment and Wealth Building. A woman walked into my office after having recently come into a modest inheritance. She felt overwhelmed by the countless number of investment options and the many unfamiliar investment terms. Her story is not unique. Many people find the world of investing intimidating and confusing. Yet investing is a crucial component of building wealth and securing your financial future. Here's a case study. An older businessman approached me after retiring from his successful full-time government career. He was single, but had a strong desire to grow his existing stock, real estate, and pension assets into a secure investment portfolio that would provide lifelong and even multi-generational income streams for several of his beloved nieces and nephews. In addition, he sought advice as how to structure his investment holdings so that his estate would never be subject to probate. The concepts of investment portfolio structures and avoiding probate were new to him, but he was completely willing to learn about the options available for him to meet his life plan and multi-generational trust and estate goals. After reviewing the details of his financial statements and tax returns, we developed both a full financial plan and trust and estate plan, and began to make the adjustments required to meet both his long-term retirement and estate plan goals. The strength of his current assets and liabilities were analyzed and updated in the balance sheet of his financial statement. Projections were developed and discussed regarding the management of his assets and liabilities for the remainder of his life and in his estate. The financial statements, tax returns, and operation of each of his current real estate holdings and other investments were also fully analyzed and discussed. Upon completion of the financial and trust and estate planning process, we began implementing both the financial and relationship actions required for him to grow his investment portfolio and fund lifelong multi-generational income streams for his nieces and nephews. Once both his financial and relationship adjustments were addressed at the personal, business, and investment levels, the client achieved a secure and peaceful life in all respects and assists his nieces and nephews to this day from the income streams of the trusts he set up with values in excess of many millions of dollars. Investment basics to get started. To begin, let's break down some key investment terms. Stocks, bonds, mutual funds, and ETFs are foundational to any investment portfolio. Stocks represent ownership in a company. When you buy a stock, you become a shareholder and own a piece of that company. Stocks can offer high returns, but they also come with higher risk. Bonds, on the other hand, are essentially loans you give to a company or government. In return, you receive regular interest payments until the bond matures, at which point you get your principal back. Bonds are generally considered safer than stock, but offer lower returns. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Managed by financial professionals, mutual funds offer diversification and professional management, but come with fees. Exchange-traded funds, ETFs, are similar to mutual funds, but trade like stocks on an exchange. They offer the benefits of diversification and usually have lower fees compared to mutual funds. Both mutual funds and ETFs can be excellent choices for those looking to diversify their investments without the need to pick individual stocks or bonds. Setting clear investment goals is crucial for a successful investment strategy. Your goals will guide your investment choices and help you stay focused. Short-term goals, such as saving for a vacation or down payment on a house, typically require safer investments like bonds or money market funds. Long-term goals, like retirement, can tolerate more risk, making stocks and mutual funds appropriate choices. Assessing your risk tolerance is also essential. Risk tolerance is your ability and willingness to endure market fluctuations. If you're risk averse, you might prefer bonds and conservative mutual funds. If you're comfortable with risk, stocks and ETFs might be more appealing. Opening an investment account is a straightforward process, but requires careful consideration. First, Choose a brokerage firm that aligns with your investment goals and style. Some brokers cater to active traders, while others are better suited for long-term investors. Look for a firm that offers a wide range of investment options, low fees, and accurate research tools. Once you've chosen a broker, you'll need to provide some documentation, including identification and financial information. Most brokers require an initial deposit, which can vary widely depending on the firm. By understanding key investment terms, choosing the right investment accounts, setting clear goals, and following a straightforward process to open an account, you can take control of your financial future. With the right knowledge and tools, you'll be well equipped to start building wealth through a consistent and long-term investment program. The power of compounding. Grow wealth over time. Compounding is one of the most powerful concepts in wealth building. It involves earning interest on your initial investment and then earning interest on the interest you've already accumulated. This creates a growth effect where your money grows at an accelerating rate over time. Imagine you have $1,000 invested at an annual interest rate of 5%. After the first year, you'd earn $50 in interest, making your total $1,050. In the second year, you'd earn interest not just on your initial $1,000, but also on the $50 of interest from the first year. This cycle repeats and repeats, and over time, the growth becomes substantial. The growth of major stock indices over decades underscores compounding's effectiveness. For instance, the S&P 500 has historically returned about 10% annually. An investment of $10,000 in the S&P 500 in 1980 would have grown to over $700,000 by 2020, assuming dividends were reinvested. This long-term growth is due to the compounding effect, where earnings generate additional earnings over time. The key point is that patience and time are your allies in investing. The longer you allow your investments to compound, the more substantial your wealth becomes. Compounding plays a pivotal role in wealth building and should not be underestimated. By understanding its mechanics, starting early, and allowing time to work in your favor, you can achieve significant financial growth. The historical performance of stock indices provides real-life examples of how compounding can transform modest investments into substantial wealth. Diversification. How to spread risk. Diversification is a fundamental principle in investing that involves spreading your investments across different asset classes to manage risk. By diversifying, you reduce your exposure to any single investment. If one investment performs poorly, others in your portfolio can offset the loss. This strategy helps stabilize returns and minimize the impact of market volatility on your overall portfolio. Diversification is not a one-time task, but an ongoing process. As market conditions change and your personal circumstances evolve, you'll need to review and adjust your portfolio regularly. For instance, as you approach retirement, you might want to shift from an aggressive to a more conservative allocation to preserve your capital. Automated tools and financial advisors can help you maintain a diversified portfolio that aligns with your goals and risk tolerance. By spreading your investments across various asset classes and regularly rebalancing, you can manage risk more effectively and increase your chances of achieving your desired, stable, long-term returns. Managing investment risk. Investment always comes with risk, and understanding these risks is crucial for managing your portfolio effectively. One of the most common risks is market risk, which refers to the possibility of losing money due to changes in the overall market. Market risk can be influenced by economic downturns, political instability, or natural disasters. Credit risk, on the other hand, is the danger that a bond issuer will default on their payments. This is more common with corporate bonds than government bonds. Interest rate risk is tied to fluctuations in interest rates. When rates rise, bond prices usually fall, and vice versa. Inflation risk, the erosion of purchasing power due to rising prices, can also diminish the real returns on your investments. Finally, liquidity risk involves the challenge of selling an investment quickly without significantly affecting its price. This is particularly relevant for real estate and certain bonds. Managing investment risks involves recognizing the various types of risk, assessing your risk tolerance, and implementing effective risk management strategies. By diversifying your portfolio and allocating assets wisely, you can mitigate potential losses. Staying informed and avoiding emotional decision-making further enhance your ability to manage risks effectively. These practices not only protect your investments, but also contribute to long-term financial stability and growth. Peace.